So most people have probably heard of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are government-sponsored entities, so they're not a direct agency like FHA or the Federal Housing Administration is, but they're government-sponsored entities. And what they do is securitize mortgages, and they sell them on the open market. So lenders, when we're doing a conventional loan, we're going to underwrite to Fannie Mae and Freddie Mac guidelines because we need to have them be able to buy the loan from us, and then they will end up selling that loan to an investor. Most investors of Fannie Mae and Freddie Mac mortgage-backed securities, or MBSs, are large investment firms, retirement account type holders, because conventional loans and mortgages in general historically have always been a safe haven. So it's a way to kind of diversify your risk in your retirement account. So if you have a 401k and you invest in, like say a Vanguard Mutual Fund, there's a pretty good chance that Vanguard Mutual Fund, a portion of that fund is actually invested in mortgage-backed securities. So if you have a conventional loan and you have a 401k in a really weird roundabout way, you might actually be paying yourself interest because there's a chance that fund actually owns a bunch of mortgage-backed securities. So what Fannie Mae and Freddie Mac do is they provide us the guidelines, and then they give us the liquidity that we need by being able to offer those loans as mortgage-backed securities that these large institutions are buying as a way to diversify their portfolio. Down payment on conventional loans is going to be 3% plus down depending upon income. So 3 to 5% depending upon income is going to be your minimum. And then obviously if you put down 20%, you don't have to have that PMI or the private mortgage insurance. Unlike an FHA loan, conventional loans price to credit. So if you have, like Mo said earlier, 760 or higher, you're going to be getting best pricing on both the loan itself and mortgage insurance or PMI. And then it's a sliding scale. So 740 to 759 is going to be a little bit different. 720 to 739, 700 to 719, 680 to 699. Anything really south of 680, unless you're putting down 20%, you're going to want to go with an FHA loan, and likely 680 to 699, you're probably going to go with an FHA loan as well, unless you're putting down 20%. If you're putting down 20%, you're always going to go with a conventional loan, regardless of the rate difference, because it's cheaper. It's better to have a higher rate in a conventional loan and not have the private mortgage insurance, because depending upon income, that PMI may or may not be tax deductible. If you make over $100K a year, that the mortgage insurance is not tax deductible, whereas the mortgage interest is tax deductible in its entirety, up to a $750,000 loan balance. So depending upon down payment, if you're putting down 20%, you will always go conventional. But anything other than that, credit score is going to dictate what loan program is going to be best for you.